Predicting housing market trends is a complex but essential part for investors, policymakers and consumers. By understanding historical cycles like the 18.6-year land cycle and use of data-driven tools, it's possible to make informed predictions. In this third and final part of this series, I'll discuss how to analyze economic indicators, leverage technological tools, and interpret global and regional trends to anticipate future movements in the US and Australian housing markets. Number 1, key indicators for predicting housing market trends. Accurate housing market predictions rely on a mix of economic, financial and social indicators. Economic indicators. Central banks like the Federal Reserve in the US and the Reserve Bank of Australia adjust interest rates to control inflation. Low interest rates typically increase housing demand by lowering borrowing costs, while high interest rates reduce affordability. Rising inflation can increase construction costs, influencing home prices. However, if wages don't keep up with inflation, it can reduce buying power and slow housing demand. Gross domestic product or GDP. A strong economy often boosts housing markets as GDP growth increases employment, income levels and buyer confidence. Housing market indicators. Inventory levels. The supply of homes for sale affects prices significantly. Low inventory in markets like Sydney, Melbourne and San Francisco drives up prices, while an oversupply can cool them down. Home price indexes. Tools like the Case-Shiller Index in the US provide data on home price trends. In Australia, similar indices track median property values in key cities, helping identify price movement trends. Rental yields. High rental yields can indicate high demand for rental properties, which is useful for investors assessing market potential in areas where home ownership is unaffordable. Demographic and social indicators. Population growth and immigration in both the US and Australia. High immigration rates can contribute to housing demand, especially in urban centres. Tracking demographic shifts can reveal where demand is likely to increase. Urbanisation and lifestyle changes. Trends like remote work, driven by the COVID-19 pandemic, have increased demand in suburban and rural areas, changing traditional demand patterns. Number 2, tools and models for housing market forecasting. With advancements in data science, various models and tools now help economists, analysts, and even home buyers make market predictions. Case-Shiller Index and other real estate price models. The Case-Shiller Index in the US is widely used to measure residential real estate prices. By comparing home prices over time, it offers insights into overall market trends and bubbles. In Australia, indexes provided by CoreLogic track housing price growth and declines in major cities, helping to assess cyclical patterns. Econometric models. Econometric models using statistical methods allow analysts to predict future trends based on historical data and macroeconomic factors. These models often consider variables like GDP, unemployment rates, and consumer sentiment to estimate price trends. Artificial intelligence and machine learning. AI and machine learning models are becoming increasingly popular in real estate forecasting. These models analyze vast data sets such as property listings, economic data, and historical prices to identify patterns and make predictions. Machine learning algorithms can adapt to new data, which improves accuracy over time. Data sources for housing market analysis. Real estate data platforms such as Zillow in the US and CoreLogic in Australia provide extensive data on home prices, sale trends, and neighborhood characteristics. Additionally, platforms like Redfin and Realtor.com aggregate listings, allowing users to analyze price trends in specific areas. These resources offer access to historical and real-time data, crucial for informed forecasting. Number 3, behavioural economics in housing market predictions. Behavioural economics examines how psychological factors influence housing decisions, particularly in periods of booms and busts. Herd mentality. Buyers and investors often follow dominant market trends, driving prices up during booms. This behavior contributed to the housing bubble in the US in the early 2000s and the rapid price increases in Australia's major cities in the 2010s. Loss aversion. Sellers tend to hold onto properties longer during downturns to avoid losses which can impact inventory levels and prolong price corrections. Overconfidence and speculation. High buyer confidence can drive speculative behavior, particularly in markets with strong historical growth such as California in the US and Sydney in Australia. Understanding these behavioural patterns can help forecasters predict the likelihood of bubbles or corrections based on market sentiment. Number 4, technological trends and the impact on housing markets. Technology has transformed the housing industry, affecting everything from the home buying process to housing demand. Prop tech and digital real estate platforms. Prop tech, or property technology innovations such as online real estate platforms, digital mortgages, and virtual tours have made buying and selling homes more accessible. These platforms generate valuable data on buyer behavior, helping analysts assess market trends in real time. The rise of remote work. Remote work has influenced housing demand in both countries, leading to increased interest in suburban and rural areas. For example, United States tech hubs like San Francisco have seen population shifts as workers seek affordability and larger spaces elsewhere. In Australia, remote work has led to growth in regional markets outside Sydney and Melbourne, with cities like Brisbane and coastal towns attracting new residents. Number 5, global factors and their influence on local housing markets. Markets in Australia and the US are influenced by global economic trends as well as local policies and regulations. Foreign investment. Both Australia and the US have seen substantial foreign investment in real estate. Foreign capital, especially from China. Foreign investment has impacted housing demand and prices in cities like Sydney, Melbourne, New York, and Los Angeles. International trade and economic policies. Global trade policies, exchange rates, and economic stability in major economies can impact local housing markets. For instance, a strong US dollar or a weak Australian dollar can influence foreign investment trends. Major global events. Events like the COVID-19 pandemic or geopolitical tensions can disrupt housing markets, impacting interest rates, inflation, and investment flows. Both Australia and the US experienced housing market shocks during the pandemic, with increased government intervention in housing policy. Number 6, recent predictions and their outcomes. United States. 2008 financial crisis. Analysts predicted a downturn after noticing unsustainable lending practices. The resulting crash affected global markets and led to reforms in US lending practices. Post-COVID boom in 2020 and 2021, low interest rates and increased demand for suburban properties led to a housing boom in the US. However, with rising interest rates in 2022, markets began to cool, illustrating how monetary policy impacts housing trends. In Australia, the 2000s boom and global financial crisis. Australia's strong banking regulations prevented a major bust in 2008. However, a slowdown followed in 2017 and 2019 as APRA tightened lending standards. Post-pandemic market. Australia's market saw a sharp rise in prices during the pandemic due to low interest rates. Rising rates in 2022 have since slowed growth, showing the influence of credit costs on housing demand. Number 7, challenges and limitations in housing market predictions. Predicting the housing market is inherently challenging due to various limitations. Data gaps and inaccuracies. Housing data can be incomplete or outdated, especially in rural or less monitored areas, impacting the accuracy of predictions. Unpredictable events. Pandemics, wars, and natural disasters can disrupt markets unexpectedly, making long-term forecasting difficult. Model limitations. Models rely on assumptions that may not hold in changing economic conditions. For instance, economic recovery following COVID-19 was more rapid than many models anticipated. So predicting future trends in the housing market requires understanding economic indicators, technological psychological impacts, and cyclical patterns. In both Australia and the US, the housing market reflects a balance between local factors like urbanisation and policy and global influences such as foreign investment and interest rates. Although predicting the market with absolute certainty is impossible, a combination of historical insights and modern data tools provides a framework to make informed decisions. This three-part series have covered the essential concepts for understanding the housing market, from recognizing the nature of booms and busts to comprehending the 18.6-year land cycle and applying predictive tools. By using this knowledge, we can better navigate the housing market's fluctuations and make more strategic decisions. Whether you are buying a home, investing, or simply seeking a deeper understanding of real estate economics. Thanks for watching, and I'll see you on the next one. Peace.